to be one of the biggest Canadian oil patch deals in over a decade, with energy giant Shell planning to take over Alberta-based oil and gas producer ARC Resources. Shell's CEO says the $22 billion merger establishes Canada as a heartland for Shell. The Prime Minister labeling the move as a good sign.
It's a vote of confidence in Canada.
The deal comes as the federal government is aiming to fast-track two major LNG projects in British Columbia. Ksi Lisims, a proposed LNG export facility that would send over 20 billion cubic meters of natural gas to Asia annually, along with another project Shell co-owns.
11 days ago, the US Commerce Secretary stood at a global economic summit and said Canada was leeching off the American economy. He said Canada had no strategic leverage worth respecting. 11 days later, Shell committed $22 billion to Canadian soil. That is not a coincidence. That is a market verdict, and it lands at the exact moment Canada needs one most. Shell plc has signed a deal to acquire Calgary-based ARC Resources Limited for $22 billion. This is Shell's largest acquisition in a decade. It is one of the largest energy deals in Canadian history, and it requires regulatory approval in Canada, the United States, and the European Union before it closes. Prime Minister Mark Carney described the announcement in one sentence: a vote of confidence in Canada. He said it on his way into a cabinet meeting. The cabinet meeting was about trade, about CUSMA, about Canada's negotiating position against an administration that has spent months questioning whether Canada brings anything serious to the table. Shell just answered that question. Here is what Shell is actually buying. ARC Resources holds more than 1.5 million net acres in the Montney Formation, one of North America's richest natural gas reserves, straddling northeastern British Columbia and Alberta. Shell already holds 440,000 acres in the same formation. Combined, that position makes Shell the number 2 producer in the Montney, behind only Denver-based Ovintiv. Verify. Ovintiv #1 ranking in Montney confirmed before production. ARC's average production runs approximately 410,000 barrels of oil equivalent per day. The Montney assets produced 374,000 barrels of oil equivalent per day last year. The deal adds roughly 2 billion barrels of proved and probable reserves to Shell's books. But the production numbers are not the real story. Shell already owns 40% of Ling Canada, Canada's only operating liquefied natural gas export facility, located in Kitimat, British Columbia. ARC's Montney gas feeds directly into that terminal. This acquisition connects the upstream supply to the downstream export infrastructure, one integrated chain, from the wellhead in Alberta and BC through the Kitimat terminal onto specialized tankers and into Asian markets paying premium prices. That integration is the entire strategic logic of a deal this size. Ling Canada Phase 1 began operations last year, the first long export facility of its kind in Canadian history. Shell and its partners, Japanese, Malaysian, Chinese and South Korean, are now contemplating Phase 2. A final investment decision has not been taken, but if it is, the numbers are significant. According to the Federal Major Projects Office, which Ottawa established to fast-track approvals for projects in the national interest, Phase 2 would make Ling Canada the largest Ling facility in the world. It would bring $33 billion in private sector capital into Canada. Verify, $33 billion figure, cross-reference Federal Major Projects Office directly, and here is the geographic fact that makes all of this commercially viable. Ling Canada sits on the BC coast. Ships from Kitimat reach Japan, South Korea and China faster than any vessel leaving the US Gulf Coast, which must route through the Panama Canal or around South America. In a market where buyers pay per million British thermal units, distance is price. The timing of this deal is not incidental. Fighting in the Middle East has disrupted production from Qatar, one of the world's largest Ling suppliers. Verify. Current status of Qatar Ling disruption. Confirm production impact figures if available. Asian buyers who depended on Qatari supply are looking for reliable, long-term alternatives. European buyers, already under pressure from the ongoing shift away from Russian pipeline gas, face the same problem. Canada offers something neither the Middle East nor Russia can currently: a stable jurisdiction, a proven resource base, and a shorter shipping lane to Asia. Subsea World Markets analyst wrote that Canadian LNG projects look increasingly attractive given Canada's low geopolitical risk profile. They specifically named LNG Canada Phase 2 as having a high likelihood of a final investment decision this year. Shell's acquisition is what makes that decision possible. It now has the upstream resource base to guarantee the gas volumes that would justify $33 billion in expansion capital. Phase 2 just became considerably more likely. There is one detail worth sitting with. Shell left Canada roughly a decade ago. It sold off a significant portion of its Canadian assets and reduced its footprint here. Now it is back, with the largest acquisition it has made in 10 years. It is returning while a trade war is active. While CUSMA is under review, Washington is publicly casting doubt on Canada's economic value. The company that walked away from Canada is now making the biggest bet on Canada it has ever made. Mark Carney did not respond to the Shell announcement with a press conference. He called it a vote of confidence and walked into a cabinet meeting on trade. That framing is deliberate. Canada's negotiating position in any trade dispute is stronger when global capital is moving toward Canadian assets